Welcome to Breaking News to Trading Moves. Today we're looking at a major development in the airline industry. Spirit Airlines is planning a really substantial restructuring. Our focus is to sort through the details provided in the materials and figure out the market consequences, who stands to gain, and who might be negatively affected by this big capacity reduction. The headline fact is pretty stark. Spirit Airlines is shrinking its operations in a major way as part of a Chapter 11 process.
It really is a considerable pullback. Management's reasoning, based on what we've seen, points to some persistent problems. Things like overcapacity in that budget end of the market, demand that hasn't really bounced back strongly in some key areas, and just relentless pressure on fares, the low-cost model kind of eating its own tail in a way.
Okay, so how are they actually planning to address that? What are the mechanics of this reduction?
The plan involves cutting the fleet by nearly 50%. It's quite something. They're going to court to get approval to reject 87 aircraft leases. And there are separate deals being worked out for another 27 planes. Add it all up, and that's a huge chunk of their flying capacity just gone.
Wow, 87 leases rejected,
Right.
plus the others. It's a lot of planes to park. And operationally, what does that translate to on the ground?
Well, it means Spirit is planning to pull out of more than a dozen U.S. airports completely.
A lot entirely.
Yes, and slash dozens of routes across their network. So this isn't just trimming around the edges, it's a fundamental reshaping of their footprint.
And to manage this kind of process, they'd need some financial stability, right?
Yeah, absolutely. You can't undertake something this complex without funding. The materials mention they've secured financing up to $475 million. That capital injection is really key to keeping the lights on and the planes flying, the ones that remain, while they navigate the whole legal and operational restructuring.
Okay, that sets the stage. Now let's talk impact. When a carrier pulls back this much capacity, it definitely creates openings elsewhere. Who are the potential winners here?
Right. The material suggests looking at three main groups that could benefit. First up, the established legacy network carriers.
Okay, the big guys. I'm guessing the immediate thought is pricing power, right?
Right.
Less cheap competition means they can charge more.
That's definitely part of it, yes. But it's maybe more about managing yield effectively. Spirit, being an ultra-low-cost carrier, or ULCC, often forces prices down on any route they fly. When they pull out of these overlapping leisure trunk routes, that intense downward pressure eases up quite a bit.
So carriers like Delta Airlines, ticker DAL, and American Airlines Group, ticker AAL, they don't have to match those super low fares anymore on certain routes.
Exactly. It lets them manage their revenue per available seat mile, their yield better in those city pairs Spirit leaves. They can potentially maintain better pricing discipline without Spirit undercutting them constantly. It helps their overall profitability mix on those routes.
Makes sense. Okay, who's the second group of potential beneficiaries?
This would be the more flexible, leisure-focused carriers. Think companies like Allegiant Travel, ALGT, and also JetBlue Airways, JBLU.
Why are they positioned well? Is it just about grabbing market share?
It's about their ability to move quickly and capitalize on those specific market share opportunities, especially in leisure markets. Allegiant, for example, is known for having a very flexible scheduling model.
Ah, so if Spirit suddenly cancels, say, a popular Florida route.
Right, let's say Fort Lauderdale to somewhere popular. Allegiant or JetBlue might be able to jump in relatively quickly and add service to capture that now available demand.
Before the bigger legacy guys can reconfigure their more complex networks.
Precisely. They can sort of cherry-pick the attractive routes that Spirit is abandoning. This ability to quickly absorb that displaced demand, especially in places like Florida where Spirit had a big presence, gives them a nice near-term opportunity. Could even become a longer-term advantage if they lock in those routes.
Okay, interesting. Now, the third winner you mentioned, the aircraft lessors. This one feels a bit counterintuitive. They're getting planes back, possibly unexpectedly. Why is that good for them?
Yeah, it seems odd on the surface, doesn't it? But it's all about the current market dynamics for aircraft. These lessors are getting back a whole bunch of A320 family jets.
Which are?
Highly sought-after narrow-body planes, the workhorses of many airlines. And here's the critical part. The supply of new aircraft from manufacturers like Airbus is really tight right now. There are production delays, supply chain issues.
Okay, I see where this is going. So demand for good used A320s is actually very strong.
Extremely strong. So these lessors, instead of being stuck with an asset nobody wants, are getting back planes that other airlines around the world are clamoring for. They potentially have the leverage to lease these planes out again, maybe even at better rates or terms than what Spirit was paying.
So they can remarket them quickly.
Exactly. And the materials note that settlements have already been reached with some lessors, which helps smooth the process. Companies like AirCap Holdings, ticker AER, and Air Lease Corp, ticker AL, are mentioned here. They're in a strong position with those returned assets.
Okay, that clarifies the potential upside quite well. But as always, there's another side to this. Let's switch gears and look at the companies potentially facing difficulties because of Spirit's pullback.
Right. The first group, perhaps obviously, is Spirit's direct peers in the ultra-low cost space.
Well, Spirit itself, SAVE, is clearly under pressure. They have the massive task of actually executing this restructuring and getting court approvals. Lots of uncertainty there.
Absolutely. But the issue is broader. Spirit's situation highlights just how intense the margin pressure is across the entire ULCC sector right now. It's a tough model when costs rise. So this puts pressure on similar carriers. Frontier Group Holdings, ULCC, comes to mind. They're competing for the same cost-conscious travelers.
How does it affect them? Do they just pick up Spirit's passengers?
It's not that simple. They might face challenges trying to absorb that capacity profitably, or they might find themselves in even tougher price competition for the remaining demand in a sector that's clearly facing headwinds. It sort of validates the concerns about the whole ULCC model's current health.
Okay, that makes sense. What's the second category of companies facing potential issues? This one sounds a bit more technical engine makers and aftermarket service providers.
Yes, this ties into some known industry issues. Spirit's cuts are happening against the backdrop of ongoing reliability problems with the Pratt & Whitney engines on some A320neo aircraft. That's already causing headaches for airlines globally.
So Spirit's cuts add another layer of complexity. How?
Well, think about the MRO market: maintenance, repair, and overhaul. On one hand, fewer Spirit planes flying overall could mean less demand for routine scheduled maintenance checks. That impacts the steady work MRO providers rely on.
Okay, less routine work.
But at the same time, the engine issues affecting the planes still flying, or those grounded specifically for engine fixes, mean very high and often unpredictable demand for specific intensive engine repairs and parts. Shop visit times are longer.
So it distorts the normal flow of maintenance work.
Yeah.
Less predictable volume.
Exactly. It creates uncertainty. This can impact suppliers like RTX Corp, ticker RTX. They own Pratt & Whitney, and also parts suppliers like HIE Co., ticker HEI. Their planning relies on somewhat predictable fleet usage, and Spirit's actions, combined with the engine issues, really muddy the waters.
Got it. The unpredictability is the main challenge there. Okay, in the final group potentially facing headwinds, you mentioned online travel agencies, OTAs.
Specifically, OTAs whose business model relies heavily on high volumes generated by searches for the absolute lowest fares.
How does Spirit's exit affect them? If a traveler just books on another airline via the OTA, isn't that okay?
Not entirely. A big chunk of initial search activity on some OTAs is driven by people looking for those rock-bottom fares that ULCCs like Spirit provide. That ultra-cheap inventory acts like an anchor, drawing lots of clicks and initial engagement.
So when that cheapest option disappears from many routes,
It can reduce the overall volume of searches, click-throughs, and maybe even bookings that originate from that quest for the lowest price point. Platforms like TripAdvisor, TRIP, or Sabre, SABR, which rely on transaction volume and GDS bookings, might see a dip in that specific type of activity in affected markets, even if the passenger ultimately books a slightly more expensive flight.
okay, that covers the landscape pretty well. Let's bring together now and look at the specific trading angles that were suggested in the materials, connecting the analysis to potential market viewpoints.
Okay. Starting with the long ideas, these generally focus on companies filling the gap left by Spirit.
Right, so for Delta, DAL, and American, AAL, the idea is potential near-term yield improvement on those roads. Spirit is leaving. But there's a note of caution, isn't there?
Yes, the suggestion comes with a caveat.
Right.
You really need to watch their upcoming revenue reports closely, see if that yield improvement actually materializes and how their overall passenger mix or load factor evolves.
And for the lessors, AirCap, AER, and Air Lease, AL.
The thinking there is based on that leverage they now have with the returned A320 family jets. The potential to release them quickly on favorable terms in a tight global market is the key driver for that long idea.
Okay, now for the other side, the cautious perspectives, or potential short ideas.
Unsurprisingly, Spirit, SAVE, itself is viewed with caution. The success of the whole restructuring hinges on execution and navigating the bankruptcy court process. It's a high-risk situation until they emerge with a clear, stable operating plan.
Makes sense. And the engine and parts companies.
Right, RTX Corp, RTX, and HEI are also flagged for a cautious view. This reflects the ongoing sensitivity around those A320neo engine issues, now compounded by the unpredictable fleet utilization resulting from Spirit's major capacity cuts. There's just more uncertainty around their near-term performance.
So this whole Spirit situation really exposes some fault lines in the ultra-low-cost approach, while also highlighting how quickly other players might adapt. It leaves a question for you, the listener, to consider. Beyond the immediate winners and losers, could this be a moment where flexible carriers like Allegiant manage to grab routes previously dominated by Spirit and actually build a lasting competitive advantage from it? Does this pave the way for them to secure a more profitable long-term position in those markets?
This analysis is not financial advice or buy or sell recommendations. This is purely the opinion of the author.